Chapter 14 then is a key topic in management accounting, which is a variance analysis. These calculations then are important in your exam and can be expected to be tested in section A and also in section B. What we're going to be doing here then is learning how to calculate all of the different types of variances. So we've got lots of different types of variances to calculate, and then we'll be looking at interpreting what these mean, so understanding what the different types of variances mean and what their implications are. We'll also be looking at how we can apply these to exam questions, so different types of calculations that we might have to do, actual figures or standard figures, so-called working backwards, as well as thinking about some of the discursive elements, such as factors to consider and interrelationships between variances, along with their significance and how we could eliminate them. We'll also be having a look at an overview then of control reports that management can use to initiate action, which is going to improve the situation. So lots to cover in this chapter then, starting with the calculation of the variable cost variances, then the fixed cost variances and the sales variances. And those fixed cost variances will relate back to what we've just been looking at with the under and over absorption of variances. Once we've worked out how to calculate them, we're thinking about the usage of them. So as I said, thinking about interpreting them and looking for linkages, and also thinking about differences under absorption costing and marginal costing stemming from the treatment then of fixed overheads. And that's going to result in different operating statements in the same way as using absorption costing compared to marginal costing resulted in different profit figures earlier on. And then finally, as I said, some exam technique on backward variances. When we produce a variance calculation, we're going to end up with a difference between our actual results and our expected results. A favourable variance occurs then when performance was better than expected. So, for example, if sales are more than you expected, or if costs are lower than you expected. So favourable variance is then when things are better, and adverse is when performance is worse than expected. So as well as doing the calculations, you can be required to state whether adverse or favourable. And because each standard cost is made up of both a quantity and an expenditure element, we'll have two variances. So for example, for materials, we'll have an efficiency variance based on the amount of materials that was used, or a usage variance, and we'll have an expenditure variance based on the price of the raw materials. What we need to do then, first of all, is work out how much the standard cost was for the actual production. And that's the flex budget element that we were seeing in chapter 13. Before we get too far into the chapter and all of the lists of variances, what we're basically looking at is comparing two things, should and did. So what we're effectively looking at then is the difference between the expected results, so the should cost or should use, and the actual results, so what we did use or what it did cost. So with variances then, there are lots of formulas to learn, but they're basically all the same, should and did. So how much, if we're looking at materials, how much materials should we have used compared to how much materials we did use for the actual level of production. So we're comparing like with like. And then in terms of price, how much should the amount of materials we bought have cost compared to how much it did cost. And by comparing the should and did for the actual quantity or the actual production, what we're going to be able to do is to strip out the effects that's due to changes in the quantity. So with materials then, we start off with a total variance. So that's the actual units should cost and the actual units did cost. So you can see these words should and did coming down here. So actual production we're looking at the two elements here, what it should use and what that should cost. So what we're going to take is the actual production and times that by the standard cost per kilogram and multiply that by the standard number of kilograms per unit. And we're going to compare that to what the actual materials for actual production did cost. And that total variance can then be split down into two elements. It can be split down into price, because we paid more or less than we were expecting for those materials, or it can be split down into usage, because we used more or less than we were expecting. The price variance then is based on the cost per kilogram. What should the materials have cost and what did they cost? And it's based upon the actual quantity of materials purchased. So if we bought 10,000 kilograms, what should they have cost and what did those 10,000 kilograms cost? And that's going to tell us whether we paid more or less than we should have done. Finally, for usage then, this is based on the actual number of units produced. How much material should it have used compared to how much it did use? So actual production should use, and that should be kilograms, compared to how much it did use. So again, should and did. The difference is that we're going to end up with our usage variance or any of our efficiency variances with a difference in kilograms. And we always value any differences at the standard cost. And this tells us then how much difference there was compared to standard, because we used more or less material than we were expecting to. What we have in worked example 1 then is some information, and then we're able to calculate the material price and the usage variances. So what we're going to be doing then is having a look at whether things came in at what they should have cost or not. We're given some information then about what should have happened and what did happen. So the should is going to come from the standard cost card, and then the actual purchases made of 35,464 are what it did cost. So what we want to do then is to use this information to calculate our price and usage variances. So the price variance then is based upon actual purchases. What should those materials have cost? Well, we bought 35,464, so we're going to use that then as the number of units, but we're going to multiply that by the standard cost per kilogram. So 35,464 kilograms should have cost 159,588 at a standard cost of $4.50 each. So this gives us our should. Then we've got our did, so it's the same quantity, the 35,464, but it's based on what we actually paid for them, which was $4.75. So it's actually cost us $168,454. The difference then is the variance, and the difference is 8,866, and that is an adverse variance, and it's adverse because we've paid more. So we've paid an extra 25 cents per kilogram here. Then we need to do the usage calculation, and this is going to be based on actual production. So actual production was 8,900 units. In the standard cost card then, each unit should have used 4 kilograms of material. So to make 8,900 units, we'd have been looking at 35,600 kilograms. In actual fact though, we used slightly less than that. We used 35,464. So we've got a difference then of 136 kilograms, and it's favourable because we've used less, and we need to value that at the standard cost per kilogram. That gives us an answer of $612 favourable. We weren't asked for a total variance here, but if we had been asked for a total variance, then that's going to be the combination of the two. So you can see then I've just jotted down the total variance at the bottom, and that can be split down, that 8,250 into 8,866 adverse for price, so the materials were more expensive, and 612 favourable for usage. Now you may notice that the numbers on the screen are slightly different to those in your notes. That's because unfortunately there is an errata, so you can download the PDF of this from your learning plan if you want to. So difference are on these numbers here. In example 1 then, we've got a chance for us to practice some material variance calculations. So Newsco then operates a standard costing system, and we're given some information about what actually happened. So the purchases of 53,000 kilograms of material at $2.38. So that's what actually did happen, and we're given some information about what should have happened. So we'd planned then to make 25,000 units using 50k of materials at a cost of $125,000. And what we need to do then is to have a look at what actual production should have cost us and should have used. So actual production then was 27,000 units. We need to know what it should have cost us, so we need some kind of standard cost card. So we know the standard usage, and we were going to make 25,000 units with 50,000 kilograms of materials. So we were looking at 2 kilograms per unit. And the standard cost was $125,000, but that was for 50,000 units, 50,000 kilograms of material. So the standard cost is $2.50 per kilogram. And we're going to use that information when we're doing our total variance. So 27,000 units, the actual number of units, should cost $5 per unit for materials. So we should have spent 135,000 making 27,000 units. How much did we spend? That was our should. Well, we did use 53,000 kilograms of material, and we spent $2.38 per kilogram. So that's 126,140. So it costs less than we were expecting, which means that we're going to end up with a favourable variance of $8,860. What we can do now then is we can separate that variance down into price and usage. So we can split this down into price, because we paid more or less per kilogram, and usage to do with efficiency. So if we're going to look at the price variance, we're going to look at the quantity of materials purchased, which was 53,000 kilograms, and say that those 53,000 kilograms should have cost us $2.50 per kilogram, but they did cost in total 126,140. they should have cost us 132,500. They only cost 126,140. So we've got a difference of 6,360. And that difference will be favourable because we've spent less than we were expecting. Finally, we've got the usage one, which looks at the number of units, so the 27,000 units. Each one should have used 2 kilograms of materials, so we should have been looking to use 54,000 kilograms of material. We did use, however, 53,000, so we used 1,000 kilograms less of material. However, we need to put a value on that 1,000 kilograms because we can't just put 1,000 kilograms in our statement, so we need to value that at the standard cost per kilogram. And it's at standard cost, so that's 250. So that's a difference then of 2,500 favourable. And it's always worth doing a double check to make sure that these add back to give you some confidence. So if we take 2,500 favourable, the usage variance, and add it to the price variance, 6,360 favourable, that should come back to 8,860 favourable, which is the total variance, and it does. Having grasped the concepts of should cost and did cost for material, it's going to be very similar for labour, except that we're going to be looking at should use in terms of number of labour hours. So we're looking then in total at actual production again, so this idea then of the number of units we produced, and we're going to be looking at what the labour should have cost us based on the number of units and the number of labour hours per unit compared to what it did cost for the actual labour used. The rate then is going to be based on the number of hours paid, how much should they have cost us and how much did they cost us, and the efficiency is going to be based on the actual production, and it's going to be based upon how long it should have taken compared to how long it did take. And because this is in hours, we need to value it at the standard cost per labour hour. We have one extra thing here with labour, which is what we call idle time. Sometimes then we might have a situation where staff are at work and willing to work, but for some reason unable to. So perhaps some materials haven't arrived or the machine is broken down. And that's going to be the difference between the number of hours that they should have worked and the number of hours that they actually worked. So the difference between the hours that they worked and the hours that they were paid for. And the difference then will be again valued at standard cost per hour. And the idle time variance will always be adverse because it's never going to be favourable, it's never going to be good news to have staff who are being paid sat around drinking a cup of tea. So we're going to be having a look at Yardco, and we've got some information about the standard cost for 3,000 units is 12,000 hours at a cost of $12.50. So all of this information in the first sentence then is our should. Last month though, we've got some information about what actually happened. So this is going to be our did. So the number of units made and the cost for that and the number of hours taken. So if we're looking at our total labour rate variance, we need to look at the standard usage or the standard labour hours. Well, we've used 12,000 hours in our plan to make 3,000 units. So the standard then is 4 hours per unit and the standard cost is $12.50 per hour. So we're saying then that the standard cost for 1 unit is going to be $50. So when we're doing our total labour variance, we're saying that it should cost $50 per unit. And we made 2,195 units. So each one should take 4 hours at $12.50. So we should have been looking at a labour cost of 109,750. Actual labour costs though was slightly more than that, 110,750. So that means that we've got a total variance of 1,000 adverse. And what we're going to do now then is to break that variance down into rate. So this is the impact of paying more or less per hour, and efficiency, so to do with the speed at which the production is achieved. So if we're looking at the labour rate variance, we're looking at the actual hours paid. So actual hours, which in this particular case is 9,200, should cost, well, the standard cost per hour is $12.50. So 9,200 hours at $12.50 is $115,000. What did it cost? Well, for those number of hours, it was 110,750. So you can see then that we've got a favourable variance because we've spent less, and when we calculate that, we can see that that's a favourable variance of $4,250. Finally then we've got the efficiency one, so looking at how quickly they made the units. This is based on the actual production, so 2,195 units should take, well, each one should take 4 hours. So that means that we should be looking at 8,780 hours. It did take longer than that. It took 9,200 hours. So it's going to have taken 420 hours more than anticipated. And we need to value that at the standard cost of $12.50. So we've got standard cost multiplied by the number of hours, and that's going to give us 5,250. And that's an adverse variance because it's taken longer than we were expecting. And the sum of those two variances is 1,000 adverse, which is the total variance. For example 3 and FlightCo, we're looking at calculating the idle time variance. Remember, this is the difference between the number of hours paid and the number of hours worked. So we're given some information then that we would expect to receive about the number of units being produced and actual number of units being produced. And we're also given information about the standard labour cost per unit. For the idle time variance, we need to look at the difference between the hours paid, which, if you like, is the should work. So to relate this back to should and did, you'd expect people to work for the number of hours that they were paid, which was 2,300 hours. The hours worked, this is the hours that they did work, were 2,200. So we've got 100 hours of idle time, and we need to value that at the standard cost per labour hour, and the standard cost per labour hour is $7. So we end up with a variance of 700, and that's 700 adverse. So that's answer A. Next then we need to think about variable overheads. And we deal with variable overheads before fixed overheads because they're more straightforward. The variable overheads then are just like the other variable costs. We've got two variances. We have the expenditure one, which is always going to be based on labour hours. So we always make the assumption then that our variable overheads will be incurred per labour hour. And then efficiency is based on production. The efficiency variance then for variable overheads, because it's based on labour hours, the difference here will be exactly the same as the labour efficiency variance. So we just need to value the difference then at the standard variable overhead rate per hour rather than the labour cost per hour. With fixed overheads, we have a slight added complication, which is depending upon whether we're using absorption costing or marginal costing. So we're going to start off having a look at fixed overhead variances under absorption costing. With fixed overheads then, it's slightly more complicated than the variable overheads, and that is because it's different depending on whether the company is using absorption costing or marginal costing to account for its overheads. We're going to begin with absorption costing because that's the most complicated and has the most variances. You should recall from chapter 13 on standard costing that we have already looked at under or over absorption. So just to recap then before we move on, that the overhead absorption rate is equal to the budgeted fixed overheads for the period divided by the budgeted activity. So that could be units of production, it could be labour hours, etc. And we said that the fixed overhead absorbed was going to be that overhead absorption rate, so the amount of overheads per unit, what it should have been, multiplied by the actual activity. And what we needed to do was to compare that to the actual overheads, so the value of the invoices, and make an adjustment for overabsorption if the amount of overhead absorbed is greater than the invoices, and underabsorption if we don't have enough fixed overhead. Now that under and overabsorption can be split down into volume variances and expenditure variances. And the reason for that is it could be that when we were doing our plans, there was a difference between how much we budgeted to spend and how much we actually spent, and that will be the expenditure variance. Or there could be a difference between the number of units that we thought we were going to produce and the actual number of units, so the number of units that we were sharing out the fixed overheads over, and that will result in a volume variance. So with the fixed overhead expenditure variance, it's just simply budgeted expenditure compared to actual expenditure, and because it's in dollars, the difference will be in dollars. But when we're looking at the volume variance, we're looking at how many we plan to make compared to how many we did make. So we're going to end up with a difference in units, and we value that at this budgeted overhead absorption rate per unit. Now, if the fixed overheads are absorbed on a labour hours basis or a machine hours basis, but really in your exam it would just be labour hours, we can split this volume variance into two further variances. So they're not new variances, they're just a breakdown further. So instead of the volume variance, we could have the efficiency and capacity. The efficiency variance then is based upon labour efficiency. So it's looking here then at how long production took compared to how long it should have taken. Because if we absorb fixed overheads for every hour that labour work, if if the labour are inefficient, we're going to end up with more fixed overheads absorbed. And that difference is valued not at the standard overhead absorption rate per unit, but instead the OAR per hour. The volume variance then, the volume capacity variance, looks at how many hours our factory is operational for. So the capacity is always to do with the factory. How many hours did we plan to have our factory running for? How many hours did we budget to work compared to how many we did work? And again, valued at this overhead absorption rate per labour hour. It's probably quite a good idea then to get to grips with the different variances, and if necessary refer back to the under and over absorption, or even back to the treatment of fixed overheads under absorption costing, because those areas that we've previously studied, that knowledge is required here. Then we have marginal costing, fortunately much simpler than absorption costing, because under marginal costing we only have an expenditure variance for fixed overheads, because remember, under marginal costing we're looking at all of our fixed overheads being treated as period costs, and the fixed overhead expenditure variance for marginal costing is calculated in exactly the same way as it is for absorption costing. So once you've sorted out absorption costing, marginal costing is also sorted. So we've got some information here in example 4 for Armour Limited, and the plan was to make 110,000 units in April, and the overheads were going to be 33,000, and each unit is going to take 3 hours. So what we've got here then is all of our should. What we're told though is actually overheads turn out to be slightly higher at 33,980. Only 1,000 units of the sole were produced, and labour worked for 3,500 hours. So what we've got here then are the dids. And what we have to do is to calculate all of the variances relating to fixed overheads. And remember then that the efficiency plus the capacity ratio is going to be equal to the volume ratio, and the volume plus the expenditure is going to be equal to the total variance. And that total variance is basically the under or over absorption. So let's have a look then at breaking this down and answering these questions. To work out the total fixed overhead variance then, I'm going to start off with the overhead absorption rate. And the overhead absorption rate then is the budgeted expenditure, which is 33,000, divided by the budgeted number of units, which was 110,000. So the overhead absorption rate per unit is $30. So if I'm looking at my fixed overhead variance in total, I'm going to look at my fixed overheads absorbed, which will be $30 every time we make a unit, and actual production was 1,000. So we're going to end up with 1,000 lots of $30 absorbed. So we're going to end up with fixed overheads absorbed of 30,000. Now my fixed overheads incurred, i.e. the value of the invoices at the end of the period, are 33,980. So we're 3,980 short, which is under absorption. Under absorption is adverse because we don't have enough fixed overheads in our income statement. We can then split that down into the difference then that's due to expenditure and the difference which is due to volume. So if we start off with expenditure, The expenditure variance is nice and straightforward for fixed overheads because remember, the expenditure shouldn't change if the number of units does. So the should is going to be our budgeted expenditure on fixed overheads, which was 33,000, and our did will be our actual expenditure. So our actual expenditure was $980 more. So we've got an adverse variance of 980. With the volume then, how many units different was the budget? So the budget then, how many units should we make? Well, we had planned to make 1,100. We actually made, so we did make 1,000 units. So that's 100 units then that we haven't absorbed for $30 for. So we need to value that at the overhead absorption rate per unit, which was $30. So we've got a variance here then of 3,000 adverse because we've produced fewer units than we were expecting. And you can see that the volume variance plus the expenditure variance adds back to the total variance. The final step then here is to break down that volume variance into our efficiency and capacity. So let's start off then with efficiency. This is all to do with how efficient labour were at producing the number of units. So 1,000 units, actual production, well each one should take 3 hours. So it should have taken us 3,000 hours to produce the units. 1,000 units though did take 3,500 units. So it's 3,500 hours, sorry. So it's taken us 500 hours more than we would have been expecting. And we need to value that at the standard overhead absorption rate per labour hour. And the standard overhead absorption rate per labour hour is the fixed overheads that were budgeted, the 33,000, divided by the budgeted labour hours, which was 1,100 units at 3 hours each. So my OAR per labour hour is $10. So that's a difference then of 5,000, and that's going to be adverse because it's taken longer than we were expecting. With the capacity, our budgeted hours are 3 hours per unit times by 1,100. So we plan to have the factory operational for 3,300 hours. The actual number of hours was 3,500. So that's a difference of 200 hours, and we're going to value that at the standard OAR per labour hour. So again, $10. So that's a difference of 2,000. And that's a difference of 2,000, and that is favourable. And the reason it's favourable is because we've got an extra 200 hours out of our factory that we weren't expecting. So if we have a look then, our efficiency variance was 5,000 adverse, and our capacity was 2,000 favourable, which does indeed tie back to the 3,000 adverse for the volume variance. It's worth having a look through this one in some detail again, so that you can make sure that you're happy with the interrelationships between the variances and make sure that you are happy with the terminology used. Then you can have a look at the sales variances. Sales variances then can arise for two reasons, and they will also have an impact on the profits. The first difference then can be because we might sell the unit for more or less than the standard, and the second reason could be to do with volume. We might sell more or less units than we were originally anticipating. So first of all then we're going to have the total variance, and then we'll have the price variance. So we'll have a look then at the actual number of units sold, how much should they have sold for, what should they have generated, compared to what they actually generated, compared to what they did sell for. So although these aren't cost variances, we're still going to have our should and did when we're doing our price variance. With the volume variance as well, we're also going to be looking at should and did. So how many units should we have sold, i.e. what was our budgeted sales volume, compared to how many units we did sell, our actual sales volume. The difference though comes under absorption costing and marginal costing with the valuation of these. Under marginal costing, we value the difference at the standard contribution per unit, because for every extra unit that you sell under marginal costing, you'll generate extra contribution. Whereas under absorption costing, we value it at the standard profit per unit, because for every extra unit that you sell, you'll generate an extra level of profit because of the treatment of the fixed overheads. So what we have in example 5 then is some information regarding the budget and the actual, so the should and the did for a period. So we planned to sell 10,000, actually sold 10,100 units, and we've got some information about how much those units sold for. And we need to work out the sales price variance and the sales volume variance. To be able to do the sales price variance then, we need to know how much each unit should have sold for. So total revenue then was forecast to be 51,000, and that was for 10,000 units. So the standard selling price is $5.10. If we're going to look at the price variance then, we need to look at actual sales, which is 10,100 units, and they should sell for $5.10 each. So from those 10,100 units, we should have been looking at revenue of 51,150. They did, however, sell for more than that, for 52,520. So that's going to give us a difference of $1 per unit, or 10,100. So we end up with a difference then of $1,010, and that's going to be favourable because we're going to have generated more sales revenue than we would have expected given the number of units that we sold. So that's going to be answer D. With the sales volume variance then, we're going to be looking at how many units we should sell. So that's our budget, compared to how many units we did sell, which is the actual sales. So we've sold 100 units more than we were planning to. And what we need to do is to value that at the standard. And we assume, because we're talking about standard profit, that with this company is using absorption costing. So we're going to value that difference at the standard profit per unit. And the standard profit per unit, 8,000 divided by 10,000, So the standard profit is 80 cents per unit. So that's going to give us a difference of $80, and that's going to be favourable because what we mean is that for every extra unit we sell, we're going to get an extra 80 cents of profit. So we sold 100 more, so that's a favourable variance of 80. So both of those then, sales volume and sales price variance. Once we have calculated all of our individual variances, then we're going to pull them all together in an operating statement, and that will show how we get from our original budgeted profit down to the actual profit, looking at the explanation for the differences. So in worked example 2, we have got company manufacturing mobile phone car kits, and we're given some information about the budgeted results. So budgeted contribution was 176,000 and actual contribution was 166,794. So we've got just over 9,000 less of contribution, but what we want to look at then is the reason for that. And if you look at the two statements, the first thing that might jump out is that the number of units sold and the number of units produced is different. So there's going to be a difference arising because of that, but there could well be other explanations for that 9,000 difference in contribution. So what we could do is pull together an operating statement. The operating statements then are different under absorption costing and marginal costing because of the treatment of the fixed overheads. So we're going to begin here with a statement under marginal costing. And the reason that we would know to use marginal costing is because the company is using terminology like contribution. So it must be using marginal costing principles. So here then we have the format of an operating statement under marginal costing. We start off with the budgeted contribution, and that is based on the budgeted number of units and the budgeted contribution per unit. We then need to look at the difference that's arising through a change in volume. So we start off with the sales volume variance. That will be the difference between the number of units that we plan to sell, the should sell 8,000, and actually sold, which in this particular case was 8,400. And the difference then will be valued at the budgeted contribution per unit, $22. So that's going to give us a flex contribution. And what that means then is, had we planned to sell 8,400 units, we would have anticipated contribution of 184,800. The next variance then that's to do with sales, the final one, is the sales price variance. So this looks then at the difference between what we should have sold them for compared to what we did sell them for. And it's an adverse variance because it's going to reduce down here the amount of contribution. So once we've got to the contribution from taking off the sales variances, we then need to have a look at the differences in the cost variances. So with the cost variances then we do a little tabular approach with the fixed variances in one column and the favourable variances in one column and the adverse variances in another. The fixed variances will come separately under marginal costing. So we've got our different cost variances then for material, labour and variable overheads. And once we have looked at the sum of all of those, and in this case they come to 1,206 adverse, that will give us our actual contribution figure. And you can see that that actual contribution ties back to the actual contribution on the bottom of the previous page. So our actual contribution here is the same, 166,794. Once we've dealt with our variable cost variances, we then deal with fixed overheads. And under marginal costing, you take the budgeted fixed overheads off and then make an adjustment for the expenditure variance. So what you've got here then is what was actually spent on fixed overheads in the period, actual fixed overheads, and take that away from the contribution, and that will give you actual profit for the period. So if we take a step back from this, what we can see is that this company planned to make contribution of 176,000. It actually ended up with contribution of 166,794. And the reason for that difference is mostly to do with sales. So yes, we've sold more units, which is why we've got a favourable volume, but we've done so by reducing the price. And that reduction then in the price has resulted in most of that difference. The difference in the cost variances then on the variable cost variances is not particularly large. It's just over 1,000 adverse by the time you've taken into consideration all of the variances. And we'll consider interrelationships between variances a little more later on. So we're starting to realise then that there are differences in the way that variable variances are treated under absorption costing and marginal costing, and that's down to their treatment of fixed overheads. So under absorption costing, sales volume variance is valued at standard profit per unit under absorption costing, and it's valued at standard contribution per unit under marginal costing. For fixed overheads then, we have the expenditure variance for both, but for absorption costing, we also have the fixed overhead volume variance, which can be further split into capacity and efficiency. The other difference then is the layout of the statement. So under marginal costing, we were reconciling from budgeted contribution to actual profit, whereas under absorption costing, the reconciliation is from budgeted profit to flex budgeted profit, i.e. budgeted profit for the number of units actually sold, down to actual profit.
Okay, in lecture example 6, we're going to prepare the operating statement using absorption costing principles. So previously we've prepared the operating statement under marginal costing principles, and now we're going to re-prepare it using absorption costing principles. So with absorption costing, just to remind you what we said on the previous page, we're going to reconcile our budgeted profit as opposed to contribution that we use under marginal costing, and we're going to reconcile that budgeted profit to our flexed profit, and then finally down to our actual profit. Okay, so what we need to start with here then is our budgeted profit. So I'm going to make budgeted profit working number 1. Okay, so if we say working number 1 is our budgeted profit. Okay, and we know from the previous example that we had a budgeted contribution equal to $22. And what I need to do is take that contribution and deduct from it my overhead absorption rate. So obviously everything that we're doing here at the moment is per unit. Yeah, so we had a contribution per unit of $22. And if I deduct from that my overhead absorption rate, which we're going to work out in a wee second, that would give me my budgeted profit per unit, which is what we're looking for. Okay, so to get the overhead absorption rate per unit, I'm going to take my budgeted fixed overhead. And my budgeted fixed overhead was equal to 130,500. And if I divide that by my production of 8,700 units, that would give me an overhead absorption rate per unit of $15. Okay, and if we deduct that $15 from our contribution, that will give us a budgeted profit of $7 per unit. Okay, if we go back to the operating statement, we can see that we had a budgeted number of units of 8,000. So if we take our 8,000 units and multiply it by our now profit per unit of $7, or our budgeted profit per unit of $7, that would give us a budgeted profit figure of 56,000. Okay, what we need to bring in next is our sales volume variance. And our sales volume variance is the difference between the number of units we planned to sell and the number of units that we actually sold. But what we need to do now is we now need to value that sales volume variance at profit per unit as opposed to contribution per unit. So I'm going to do another working for our sales volume variance. Okay, so you might want to take another sheet of paper just to give yourself plenty of space. Move down. And for working 2, we want that to be our sales volume variance. So I'm just using SV for sales volume. Okay, so our budgeted sales units, or our planned sales units, was 8,000 units. If we compare that to what we actually sold, so we actually sold 8,400 units. Therefore, we have a sales volume variance of 400 units, and that would be favourable. Favourable because we sold more, we managed to sell more than what we had budgeted. What we now need to value that is we need to value that at our standard profit per unit. Okay, and we've seen earlier that our standard profit per unit is $7. So if we take our 400 units and multiply it by our $7 per unit, that would give us a sales volume variance of 2,800, which we said would be favourable. We've managed to sell more than what we expected. Okay, so if we go back onto the operating statement and if we add in that sales volume variance, which we said was 2,800 favourable, so I'm going to add that onto my budgeted profit to give me a flex profit figure of 58,800. Okay, we then take in the sales price variance. The sales price variance is exactly the same as what we've seen in our marginal costing, so there's no change here, so we can just bring that in, and we had an adverse sales price variance of 16,800. If we deduct that, it gives us an adjusted flexed profit figure of 42,000. Okay, if we look at the cost variances, and we can see that a lot of these cost variances will be the same as they were before. As we stated on the previous page, the big difference between marginal and absorption costing will be in relation to our fixed overheads and our fixed overhead efficiency and capacity variance. Okay, all of the other cost variances will be exactly the same as what we've seen under marginal costing. So we're just going to copy the same numbers through here now. Okay, so you can see that we've just copied through the cost variances from what we had in our marginal costing statement. So the variances for material price and usage, labour rate and efficiency, variable overheads, expenditure and efficiency, and our fixed overhead expenditure variance. All of them are exactly the same as the previous example, and therefore the numbers are just copied through. There's 2 final calculations that we need to do then to bring in the principles of absorption costing. So we now need to work out our fixed overheads efficiency variance. So I've labelled that up as working number 3. So again, if we take a separate sheet of paper to give ourselves some space, and we're going to work out the fixed overhead efficiency variance. Okay, and what this will look at is how long our 8,900 units should have taken compared to how long our 8,900 units actually did take. Okay, so if we take our 8,900 units and we multiply that by the 5 labour hours per unit, that means that our 8,900 units should have taken us 44,500 hours to produce. When we look at the information, we can see that they actually took us 45,400 hours. So therefore we have a variance of 900 hours. And what we need to do is we need to value that variance of 900 hours. We're going to value the variance at the fixed overhead absorption rate per hour, given that we're looking at the fixed overhead efficiency variance. So if we look at what we had calculated earlier on, previously we had calculated an overhead absorption rate equal to $15 per unit. Okay, we did that when we worked out working one for our budgeted profit. If we divide that by the 5 hours per unit, that will give us an overhead absorption rate of $3 per hour. Okay, so our fixed overhead efficiency variance will be equal to our 900 hours multiplied by our $3 per hour, which gives us a variance equal to 2,700. And that variance is going to be adverse, and the reason that it's adverse is because it actually took us more hours than we expected it to. Okay, so if we go back to the operating statement and we can now slot in that efficiency variance, so it was adverse, so I'm going to plug it under the adverse column, and it was 2,700. Okay, we have one final working to do, which I'm going to label up as working 4, and that's our fixed overheads capacity variance. Okay, so let's finish it off by looking at working 4, and this is where we're going to look at the operational capacity of the factory. So if we think about our budgeted hours for the factory to be operating, we take our 8,700 units and we multiply it by the 5 hours per unit. That would give us 43,500. The factory did actually work for more than that. It was 45,400. So therefore we managed to get an extra 1,900 extra hours from the factory capacity. Okay, again, we need to value that, so we're going to value it again at the overhead absorption rate, and the overhead absorption rate, as we calculated previously, is $3 per hour. So if we take those 1,900 hours and multiply it by 3, that would give us a variance of 5,700. That variance is going to be favourable, and it's favourable because we got more hours out of the factory than we were expecting to. Okay, so to finish off our operating statement, I'm going to plug in that final variance of 5,700, this time under the favourable column. And what we need to do is to cast down to finish it off. So if we cast down our favourable column, we get total favourable variances of 14,661. With our adverse column, we have 16,441. And therefore, if we net the two against each other, we have an overall adverse cost variance of 1780. Okay, so to finish off the statement, we're going to take our 42,000 flexed profit. We're going to deduct from that our overall adverse cost variance of 1780, which will reconcile down to an actual profit figure of 40,280. 2020. Okay, and just to summarise, from our absorption costing statement, we can see that we've gone from a budgeted profit of 56,000. We've made a favourable sales volume variance because we were able to sell more than we expected to. We've had to deduct from that our adverse sales price variance, which has obviously reduced our profit down to give us our flexed profit of 42,000. We've deducted from that our cost variances. Our cost variances overall were 1,780, and that reconciles down to an actual profit figure of 40,220.
As well as the calculations then, we might need to be able to do some simple interpretation of the variances in our exam. So we need to know what they mean when we see these variances. So far we've just been calculating them without much regard for what they actually mean. We need to make sure then that when we're assessing the performance of managers and employees, that we think about what it means in the context of the scenario. And we might have to come up with reasons then why variances could have occurred or possible explanation. The table here then is just a starting point for some of the reasons. So favourable variances then with material price can come about through discounts that we weren't anticipating, shopping around and getting a better deal, or perhaps changing the quality of the material. So perhaps buying cheaper materials. A change in the standard can also affect the variant, can also be an explanation for an adverse variance because more expensive materials obviously cost more. As does careless purchasing, so perhaps buying from any supplier because you're panic buying. This could be likened to perhaps going to the corner shop or a service station where you might pay a premium for goods which you could get in the supermarket cheaper. We can also have an adverse price variance if there's some kind of increase that we weren't anticipating. With usage, we can end up with a favourable variance, perhaps because higher quality materials might mean that there's less wastage, or we might be able to use the materials more efficiently, so thinking about how we can get the best out of our materials, or it might be that we've made a mistake in allocating materials to the job. Adverse variances then for usage, well, we use more if the materials are defective, and that might be because of the quality. We might also end up with an adverse variance relating to quality if we have stricter quality control, causing more materials to be rejected because they don't get through the quality control process. You might see material usage rise if there's carelessness through wastage, or also if materials are stolen, or perhaps if they're allocated to the wrong jobs. Labour rate variances are going to be favourable if we use workers that are paid lower than the standard, so getting some cheap labour. Adverse, perhaps if we are paying a premium, perhaps through overtime or having to recruit temporary workers. Labour efficiency variances then will be favourable basically if we can produce the output quicker than the standard. And the reasons for that could be because the workforce are motivated, or they might be able to produce products quicker if the materials are of a higher quality. Mistakes then in allocating labour, again, could explain all types of variances, really, those errors. And if we have a better quality or a higher grade of labour, someone who's more skilled, they might be able to do the work faster. Adverse variances for labour efficiency can come about if we have output that's lower than the standard set, and that might be because the employees lack training or because of substandard materials. They might have to rework things which will take longer. Fixed overhead expenditure variances will incur because we're able to perhaps be more economical or negotiate our costs down. Because they're not related to volume, adverse variances will come about if the services used increase, so for example if the rent goes up, or if we perhaps have a change or some kind of excessive use. The overhead variances then ought to be traced to individual cost centres where those variances are actually going to be occurring. So we need to try and think about what's happening in those cost centres. The volume variance, remember, which is based on the number of units being produced, is likely to be favourable if we've produced more units than we thought, and the fixed overhead volume variance will be adverse if we've produced less units than we anticipated. We also need to think then about interdependence of variances. So we need to make sure then that we aren't looking at variances in isolation, because it could be that if we buy cheaper materials, we'll get a favourable price variance, but we might end up with adverse usage and perhaps efficiency variances for labour if those materials turn out to be inferior quality and there's lots of rework. Again, a flip side, paying more for labour might give you an adverse rate variance. However, that might have a positive impact on efficiency variances. So we might be able to do the work quicker and also use less materials. A company won't want to investigate all of the variances. Instead, they need to think about the size, how material that variance is, and also how controllable it is. If the material price variance is adverse because of a global increase in the price of raw materials, there's no real point in investigating it because there's nothing we can do about it. We need to think about the cost of investigation versus the potential benefits, and also think about any interrelationships occurring between other variances to make sure you can see the whole picture. The type of standard will also have an impact. If we have an ideal standard, then we're always going to have adverse variances. Think as well about the trend. It might be that variances aren't very big each month, but overall they're showing a worrying pattern. And if we decide to do something as a result of a variance, it's known as control action. In example 7 then, we can see a question where we need to apply our knowledge about the causes of variances. So a sweatshop has found that it's got an increasing adverse labour efficiency variance for the last 3 months. So it's using lots of temps to keep up for demand for its products, and as a result the products are taking longer to manufacture. What we need to do is decide which two of the following would eliminate this adverse variance or help to eliminate it. So paying more to temporary workers is unlikely to solve the problem. However, if we are going to offer overtime to our company's existing skilled employees, that might sort out the problem. It might cost more, but it would reduce the time taken potentially because they already know how to make the products. Training as well to the temporary workers would also reduce the time that it would take them to make the products, whereas reducing the number of supervisors would have the adverse effect. So B and C then answers here. Sometimes then a question might be set up in such a way that it requires us to work backwards from a set of variances to get back to the actual or the budgeted data. And that's the case here in example 8. So we want to work out then what the total standard labour hours were last month. So we're looking here then for how many hours should have been worked last month. In order to do this then, we're going to need to take the information from the question and work backwards to get to those standard labour hours. So we've been given the labour rate variance and the labour efficiency variance, and we've also been given information about how many hours were worked and what the labour cost was, the total direct labour cost. So what we need to do then is to set out the variances that we've been given and see what information we've got here. So if we look at the labour rate variance, we're looking then at our actual hours should cost. So 28,000 hours should cost, and 28,000 hours did cost. Well, we know that the actual direct labour cost was 117,600, and the labour rate variance then was 8,400 adverse. If we work backwards, to get a variance of 8,400 adverse, that must mean that we spent 8,400 more than we should have done given the number of hours. So what that means then is that the standard cost per labour hour is 109,200 divided by 28,000. So the standard cost per labour hour is $3.90. And that's going to help us because when we work back through the labour efficiency variance, we will need that value of $3.90. Let me show you how. So with the labour efficiency variance, we've got the should work for actual units, which is what we want to work out. We've got actual units did take, and we know that's 28,000 hours. And we know that the difference is valued at the standard cost per hour of $3.90. And that gives us a variance of 3,900 adverse. So X number of hours multiplied by 390 gave us 3,900. So that means that we had a difference of 1,000 hours. And it was 1,000 adverse, so it means that it took 1,000 hours longer than we were expecting. So actual units we were expecting to take us 27,000 hours. So in answer to the question, the total standard labour hours was 27,000. These questions then really test your understanding of the variance calculations. So you need to get to grips with the basics before you start worrying too much about these backward variances. However, these are very examinable because they test your understanding. And my top tip with these ones is always to write down the variances that you're given and see what information you've got, because it is all there, but you just have to work through it methodically. In example 9 then, we've got a company using marginal costing and we have to work out the actual contribution for last month. So we've been given some of the variances. And we start off by being told that the standard contribution on actual sales, or the flex contribution, is $23,000. What we need to do now then is we need to have a look at what else we need to do. Well, that flex contribution is based on the actual number of sales sold. So the sales volume contribution variance isn't going to be relevant here because that's already been accounted for in the 23,000. But we do have a sales price variance, and that's favourable. So that's going to increase the level of profits. And then we've got the cost variances. And the total cost variances are adverse, so we need to take that off. So that's going to give us actual contribution of 23,750. So the key here is knowing that the standard contribution on actual sales already includes the sales volume contribution variance. In chapter 14 then we've been looking at variances, and here we've got the summary of the chapter. But I'm sure you've realised by now that the main summary of variances is should and did. So should cost, did cost, should take, did take, should use, did use, should sell, did sell, etc. So should and did are absolutely fundamental to variance analysis. Variances basically then are showing us the difference between our actual results, so our did, and our expected results, the should. And we've seen then how we can calculate cost variances for materials, labour and overheads, and also fixed overhead expenditure variances. Under absorption costing then we're going to have another variance for fixed overheads, the volume variance, which we can split into capacity and efficiency. As well as cost variances, we can also have sales variances, which arise when we sell a different quantity of units, so sales volume variance, or we sell at a different price to budgeted. And remember, the sales volume variance is different depending on whether you're using absorption costing, in which case you value it at standard profit, or marginal costing, where you value it at standard contribution. Interpretation then of variances is also very important for the control process. We need to look at when to investigate and interdependence of variances. You'll investigate depending on factors such as size, trend, and controllability. The operating statements then are a summary of how the variances will reconcile budgeted profit and actual profits. You might have to prepare a number to go into the operating statement, or you might have to indicate whether they're favourable or adverse, or populate an operating statement in section B. Differences then, as we've said, occur between absorption costing and marginal costing. Under marginal costing, we only have a fixed overhead expenditure variance. We base the sales volume variance on contribution, and the operating statement reconciles budgeted contribution before reconciling it to actual contribution and then actual profit. And finally, backward variances, not a special type of variance, but instead a style of exam question which requires you to work from a set of variances back to original actuals or budgeted data. Lots of practice then to get up to speed with the variances will be needed.